Welcome. My name is John Davenport, partner with Impact Consulting and Distribution. I'm joined today by Justin Lowry, who's the CIO of Global Beta Advisors, one of our partner firms. As many of you know, Impact Consulting and Distribution is a third-party marketing firm. Our goal is to find undiscovered managers in our industry and bring those to advisors and their clients. So Justin, thanks for joining me today.
Thanks for having me, John.
Happy to have you. And we were going to talk a little bit about the Fed today. The Fed's made a few changes recently to their mandate, and they actually codified those two items recently in their release. One of which was they indicated that they're willing to accept a higher inflation rate. What's your take on that?
Yeah, so basically, let's start with kind of their overall objective. The Fed wants to create maximum employment and price stability in the market. And the two biggest things that they're looking at are inflation and employment. So the news on the surface was a significant policy change, but the effects were almost kind of baked into the market because the Fed, for all intents and purposes, we're looking to keep rates low through the end of 2022, at least from our perspective. So when we look at what the announcement means, back in 2012, the federal chair, Ben Bernanke, first explicitly announced a target of a 2% inflation target. Now, it's always been kind of argued whether or not that had been implicitly a target of the Fed since the mid-90s. But in any event, it has been a target of the Fed's. And what Powell's doing here is he's creating a situation where rather than looking at the monthly reads of inflation and reacting to those monthly reads, he's saying, hey, let's build out an average composite here and kind of make a broader determination on monetary policy based on that average. And that's kind of important just because of where we kind of are economically. We are in a self-induced recession right now, and we have an identifiable event causing that recession. And because of that, we could have these rolling shutdowns, these rolling economic shutdowns, be it state mandated or whether the businesses themselves shut down. And because of that, and you're in the backdrop of heavy monetary and fiscal stimulus, because of that, you may see a lot of volatility in the inflation numbers. So basically what Powell's doing here is he's creating a quantifiable way to keep rates low for a long period of time, even if the monthly numbers are to say that, hey, inflation's a little high here.
Fair enough. You also mentioned that the other side of the Fed's mandate was full employment or a robust labor market, where while the other thing that they did recently was to state that they're not so much concerned with a tight labor market. They're making the assertion that a tight labor market no longer correlates to inflation. What's your take on that?
Yeah, so it kind of challenges the whole Phillips curve theory. And honestly, we've kind of seen that happen in reverse since the end of the economic recession back in 2008. Unemployment coming out of that recession peaked out at 10% in October of 2009. And that had steadily declined right before this recession and got as low as around 3.5% in January of 2020, right before the recession started to take hold. And through all of that, the average monthly year-over-year inflation rate was 1.7%. So despite improving employment, you still had an inflation rate that was below 2%. Now, a lot of that had to do with the fact that there was accommodative monetary policy, and there was a strengthening dollar, and there was improvement in technology to create price efficiency. So there were other factors that weren't kind of contemplated in the idea of the inflation rate being impacted by the labor market. Now, we may see that happen in reverse, where there may be persistent high unemployment, and we may see ticks up in inflation because because of that stimulus that's going on right now, you're going to see kind of maybe some artificial inflation that's not being impacted by employed consumers.
And so the mantra since we came out of the financial crisis has been "Don't fight the Fed." And there was an adage that the S&P was highly correlated to the Fed's balance sheet. We've seen that break a little bit in the last couple of years, but with all of the Fed stimulus out there, should we have another shock to the system? I mean, what does the Fed have left in its quiver to really help stimulate the economy, much less the markets?
Yeah, I mean, that's actually a good question because right now, even though that they've kind of shown that they're willing to throw everything at this, with as much as they haven't really rolled out an identifiable quantitative easing program for this particular recession. And I think that between them and the federal government, they're kind of waiting to see the impact of this initial recovery and figuring out how do you respond to a potential recovery from a recession that is being influenced by a virus. It's something that's been, it's not something that really has been they've had to deal with before, and because of that, they're kind of in this wait and see environment. So, like I said, they still have actual purchasing ability that they haven't unveiled yet. And if things are contracting more than they expect, I expect them to release an actual, stated QE program.
Okay. So the two moves by the Fed recently on changing their inflation target and decoupling inflation from a labor market, that attitude. For the average investor, what does that really mean, and should they be doing anything different?
Yeah, so that's the problem here, because what happens is you've got a Federal Reserve that's saying we're willing to tolerate higher inflation, and you're looking at equity prices continuing to rise. So there's of course fear of this premium between equity prices and a depressed yield curve. So people don't want to be left holding the bag here, like what happened back in the technology boom. And obviously the impact there and the response there was not effective. And so here, I think they're trying to get ahead of what they've learned from the past. And so for investors, they have to kind of look at this and say, hey, let's reevaluate what our valuations look like, in our holdings. So if you're holding stocks or funds with high valuations, it may be time to reconsider either offsetting those holdings with funds or companies that with better valuations, or maybe it's time to start trimming and taking some cash positions.
And as you look at valuations, what are some of the more attractive areas of the market currently, or is it really on a name-by-name basis?
Well, we look at, we actually did a kind of a scope around what different styles of investments look like in different economic environments. And in this current economic environment where there may be some more inflationary pressures, we see that growth-oriented securities and low volatility securities generally perform better on a short-term and medium-term forward-looking basis. So I would suggest, obviously, growth, the valuations and growth have bubbled right now, but there's still attractive growth opportunities out there that are not as expensive as your typical headline-oriented type of securities out there. And then, of course, like I said, low volatility strategies are also a way of participating in the market without with having some downside protection. And that's why we say with these low volatility strategies, and it's very important that investors consider and contemplate valuations when they're making their decision on low volatility investments, because it is supposed to protect you on the downside. And having a fund or security with a lower valuation is going to give you that, is going to have less room to fall.
Yeah, and going back to the Fed, the ultimate outcome from the Fed's decision recently is it looks like rates are going to stay lower longer, which means investors aren't going to get the needed income from the fixed income side of their basket. And I know you guys do a lot of research on the equity side on higher income paying stocks that are at more attractive valuations. Speak to that briefly on how that fits into today's market with the Fed's low rate outlook.
Yeah. So, I think it's kind of normal for people to figure, hey, low rates, let's just jump into utilities and collect yield out of utilities. But I think people mistake the fact that utilities have quite a high premium on them right now. And that premium has been building over the past decade with general accommodative monetary policy. So I think when people are looking at achieving income, it's important to create some diversification around there. So that's why the strategies that we build, specifically in the income space, we want to make sure that we're touching on every sector and industry in the market. So we build our portfolios on a diversified level in terms of seeking yield. And then to your point about valuations, one of the critical parts of how we allocate our portfolio, particularly with income, is we're looking at revenues. And by looking at revenues, we're getting those strong, balanced fortress type of securities, and those who are generally going to have a better price to sales ratio. And our research has indicated that price to sales ratio has a higher level of correlation with future return. In fact, we did a regression analysis from data from FactSet on the S&P 500 index, and it has indicated that there's nearly a 90% relationship with lower price to sales securities and a 10-year forward-looking return. So it's in our view that people, especially those who have kind of longer-term investment objectives and are willing to sit, hold, and collect yield, that you want to consider valuations when you're allocating towards income-oriented strategies.
Great. This has been a great discussion today, Justin. Appreciate you sharing some insights on the Fed as well as what investors should be doing today. Appreciate you joining us and look forward to talking to you the next time.
Yeah, thanks for having me, John.